On Point with Craig's Investment Partners.
The information provided here is general in nature and it's not financial advice. It doesn't take into account your situation, objectives, goals, or risk tolerance. All investments are subject to risk and none are guaranteed. Before you make any decisions, we recommend you contact an investment advisor. For more information about our services in that regard, or to view the Craig's Investment Partners Financial Advice Provider Disclosure Statement, please visit our website, which is craigsip.com. Welcome to On Point. I'm Mark Lister, Investment Director at Craig's Investment Partners, and I'll be talking about a range of topics including economics, portfolio strategy, investor education, and anything else that's happening out there in financial markets. Morning team, hope everyone is well. Let's run through some of last week's key developments, then let's turn our attention to the week ahead. Well, a rough end to the week. A long period of calm ended on Friday after President Trump threatened to impose a new 100% tariff on imports from China starting on the 1st of November. This came on the back of new export controls that China imposed on rare earths minerals. So we saw the S&P 500 index in the US fall 2.4% over the week, with the market suffering its worst day in 6 months on Friday, the worst day since early April after those initial Liberation Day tariff announcements. Higher growth stocks suffered the most, while the only two sectors to rise over the course of last week were utilities and consumer staples. The other 9 sectors were down for the week. Other markets also had a difficult week. UK shares off 0.7%, Europe down about 1.2%, emerging markets down slightly, Australia down slightly. Japan bucked the trend. Japanese shares were up about 2%. Some of the international weakness was offset here in New Zealand by some currency weakness. The Kiwi dollar down against the US dollar to the tune of about 2%, down against the pound, down against the euro. So that did offset some of that weakness we saw in international shares. Here in New Zealand, the local NZX 50 held up better than most. It slipped 0.3%, but like I said, that weakness in the US really came through on the Friday trading session and we were closed, so maybe we will be on the back foot this week, one would expect, when we reopen on Monday. Better news though, we did hit a new record high during the week. The NZX 50 closed above its previous peak, which came all the way back in January 2021. So finally, we have retaken that high. And the NZX 50 has returned 2.7% this calendar year, so much more subdued than most, but it is up 14.4% from the lows of early April. Interest rates slipped back in most places. In the US, the 10-year Treasury yield finished the week just over 4%, and here in New Zealand, the 5-year swap rate fell to just below 3.1%. That was the lowest we'd seen since March 2022. Right, looking back at some of the key events from last week, and here in New Zealand, the Reserve Bank took centre stage, and it did choose to cut the OCR by 50 basis points, like many of us were hoping for. The decision was a consensus one, so they didn't need a vote. That highlights just how clear-cut it was for the committee. Markets had obviously fully priced a 25 basis point cut, and it looked 50-50 whether they would go that extra mile and do the bigger cut. So this was the 8th reduction this cycle. It was the first 50 basis point cut since back in February, and it sees the OCR now at 2.5%, which is obviously well down from that 15-year high of 5.5% that we saw last year, and it's at the lowest level we've seen since mid-2022. From here on, there is one more decision due that comes out in late November. That will be a monetary policy statement, which means you'll get a new forecast set. It means you'll get a press conference. We didn't get either of those things last week. Markets right now are picking another 25 basis point cut at that time. That would take the OCR to 2.25%. Now, that might be it, or they might have to do more. We'll just have to wait and see. That November meeting will be the last one for this year, and after that, they take an extended break, and the next meeting after November is mid-February. So there's almost a 3-month gap. So whether they go even lower again, down to 2%, or whether they stay put at 2.25, because that next cut looks to be pretty locked in. That will depend on how the economy responds to what we've already seen. So I think the key releases to watch over the near term are that September quarter inflation report, which is due on the 20th of this month, and then the labour force report that's due on the 5th of November. That's my wedding anniversary, so I won't forget that one. And confidence indicators, signs of improvement across the housing market, they will also be important as we move forward. So good news, I think, for borrowers and for businesses and for investors with that bigger 50 basis point cut, and it won't be the last cut we see this cycle. We also got some dairy auction news, and dairy's losing streak did continue. The global dairy trade auction saw the headline index fall 1.6%. That was the fourth decline in a row, actually the eighth decline out of the last 10 auctions. So the headline GDT index is now about 12% below where it got to in May, although that was a 3-year high. It's down about 3% year to date. At least we have seen the currency come off the boil a little bit, which will be helping its cause in terms of where that payout goes. And I think most of the banks are still fairly comfortable with that $10 payout from Fonterra for this season. Right, looking to the week ahead. And internationally, obviously, the government shutdown, I think, now into its 12th or 13th day. No signs of a compromise just yet. Poly market odds of it ending before October 15 have slumped to just 5%. So it does look like it will drag on. We were meant to get the September CPI report on Wednesday, and that would have been the economic highlight of the week in the United States and probably globally. But that has been rescheduled for the 24th because of the shutdown. So if it does come out on the 24th, and hopefully things have reopened by then, that means the Federal Reserve, when they meet late in the month, will have the luxury of having seen that CPI report. But we've still missed a whole bunch of other reports that we would normally have seen by now, most notably that jobs report from last month. Also in the US, worth noting that it's Columbus Day on Monday. That won't be a holiday for share markets, but it will be a holiday for bond markets. So bond markets in the US will be closed on Monday. At least we can count on the private sector to remain open stateside, and there will be a slew of corporate earnings releases to fill the gap because the international quarterly reporting season really ramps up this week in the US and elsewhere. I think there's 30 or 40 S&P 500 companies due to report. Some of the banking heavyweights, as always, will be some of the first ones to announce results. We've got BlackRock, Goldman Sachs, Bank of America, Citigroup, Morgan Stanley, but a raft of other companies too. Johnson & Johnson, United Airlines, American Express. Also the semiconductors will be in focus, ASML, and TSMC reporting results. So there'll be a lot to watch on the corporate earnings front. Here in New Zealand, there's a couple of things to keep an eye on. We should get a new housing market report from the Real Estate Institute. Not sure what day that's out, but I'm expecting it early this week. This should cover the month of September, and it'll be interesting because last month's release was still pretty sluggish in August, but there were some improving signs. And at some point, you would think that these lower mortgage rates will boost confidence and you will see a bit more activity, potentially a bit more upward pressure on prices across the housing market. We don't want too much upward pressure. Affordability is still very much an issue across many parts of the country, but you want the market to be a little more solid than it has been so that it does keep optimism at higher levels rather than keeping people too pessimistic. We'll also be watching an RBNZ speech from the chief economist, Paul Conway. He is scheduled to deliver a keynote at the City Investment Conference across the Tasman on Wednesday, and I think he is scheduled to go on at 9:45 a.m. Sydney time, and that will be 11:45 a.m. New Zealand time. So this speech is expected to cover lessons from monetary and fiscal policy during COVID-19, and we'll all be watching for any further clues about what the RBNZ might do next or what their train of thought is. They will release a bulletin article onto their website and an analytical note at the same time as Mr. Conway is speaking. So I think that will be quite closely watched on Wednesday, just before midday, because of what we saw last week. Also, there are a couple of corporate things to watch here in New Zealand and across the Tasman too. A few AGMs, not too many results, but AGMs. We've got Genesis Energy on Thursday here in NZ. Across the Tasman, it's quite busy. Telstra, Commonwealth Bank, Origin Energy, Stockland, all of those businesses holding annual meetings, and that usually means we will get trading updates. So lots to keep an eye on. Even though we won't get a US CPI report, I think the government shutdown will become increasingly important for investors, so we'll be watching that very closely. The longer it drags on, the more of an inconvenience it becomes, and the more it does start to maybe have impacts on the economic fundamentals of the United States, particularly across some sectors and for a lot of workers. And we'll also be watching for more developments on the tariff front after those developments on Friday between China and the US. So lots to keep an eye on. Thanks for listening, team. We'll talk again soon.
For more insights, visit craigsip.com.